Good morning, ladies and gentlemen, and welcome to this press conference on the European Commission's winter economic forecast. The forecast as well as the press material have been published now. I will give the floor to Commissioner Gentiloni for a presentation of the forecast, and after that, as usual, we'll take your questions. Commissioner Gentiloni, the floor is yours.
Thank you, and good morning, everyone. Let me begin with five key messages emerging from this forecast. First, the economic situation this winter remains challenging. Since the autumn, many member states have reintroduced tightened containment measures in response to the resurgence in infections and more recently to the spread of new variants of the virus. To be clear, these measures are necessary. But of course, they affect economic activity, although to a much lesser degree than in spring last year. Second, because the recession in 2020 was not as deep as expected, and thanks to the breakthroughs regarding vaccines, we now project the EU economy will return to its pre-crisis GDP level in 2022. This forecast assumes that the current strict containment measures will ease towards the end of the second quarter this year, and then more markedly in the second half of the year, when the most vulnerable and an increasing share of the adult population should have been vaccinated. Containment measures are then assumed to be marginal towards the end of this year, with only targeted sectoral measures still present in 2022. Overall, EU GDP is now forecast to grow about 3.7% this year and 3.9% in 2022, after a contraction estimated at 6.3% last year. In a few words, compared to our previous forecast in autumn, a smaller contraction in 2020, lower growth in 21, and stronger growth in 22. Third, the recovery is set to be uneven across member states. This mainly reflects differences in the structure of each economy and the relative importance of tourism and leisure activities. Fourth, uncertainty and risks to the assumptions I have just mentioned remain very high, as all forecasts in these times. They are linked in particular to the evolution of the pandemic, including the emergence of new variants and the success of vaccination campaign. And fifth, this forecast does not take into account the potentially very significant positive impact of Next Generation EU. We simply lack sufficiently data for this, as I will explain. So the pandemic has tightened its grip on Europe since autumn. The rate of infection has seen an acceleration in many countries, followed by a new surge in hospitalization rates and deaths. More recently, new, more infectious variants of the virus have also started to spread in some countries. National authorities have rightly decided to tighten restrictions, as illustrated in the slide by the Oxford Stringency Index and the decline in Google Mobility Index. However, the economic impact of these new restrictions appears less pronounced than during the first wave of the pandemic. The current measures are less harsh and more targeted compared with those imposed in March and April last year. Industry and construction have been largely allowed to operate. Schools and kindergartens have remained open in most countries. Together with an extensive use of remote working, these measures have prevented the denting of the labor force. The third quarter of 2020 saw very strong growth in the European economy. We could not fully factor it in our autumn forecast. In the fourth quarter, the EU economy is estimated to have contracted by 0.5. But this decline is obviously not comparable with the sharp drop in the second quarter of 2020, when the first wave of the pandemic hit. Overall, the European economy contracted less over 2020 as a whole than we had projected back in November. Over the first weeks of 2021, surveys are continuing to suggest depressed economic activity. But beyond the first quarter, the economy is expected this year to start picking up in line with our assumption of a gradual lifting of restrictions towards the end of the second quarter. Looking at the international picture for a moment, the global economy rebounded strongly in the third quarter of 2020 after the severe contraction in the first half of this year. The outlook for the medium term has improved, thanks to the vaccination campaigns in advanced economies and stronger policy support, particularly in US and Japan. After an estimated contraction of 3.4 last year, global GDP, excluding the EU, is set to rebound by 5.2 in 21 and grow by 3.8 in 22. Global trade in goods, again excluding EU, expected to recover in line with the global economy. And this is good news for us. Of course, the picture is far bleaker in the poorest part of the world. Kristalina Georgieva has warned that in low-income countries, the shocks are so profound that we face the risk of a lost generation, with close to 90 million people likely to fall below the extreme poverty thresholds during 2020-2021. The Commission's latest surveys point to ongoing sectorial divergence in Europe. And this is not a surprise. While industry is on the mend, services relying on close person-to-person contact have remained weaker. This does not come as a surprise, given the impact of containment measures on demand and supplies for services, such as travel, tourism, restaurants, and entertainment, as we all know. As restrictions on services should be gradually eased, the services sector is also set to rebound and to narrow the gap with the industrial sector. The labor market, the pandemic, the containment measures, and the resulting sectorial divergences have had uneven implication for the labor market. As I just mentioned, the measures mainly affected contact-intensive services, where employment was restricted or fully suspended. But the containment measures are important for the whole economy. Compared to past recessions, the increase in the unemployment rate was limited, although unequal between genders, rising more for women than men. At the end of last year, after having peaked in the summer, the unemployment rate in the EU and the euro area stood only slightly higher than before the pandemic. This is the result of the cushioning by government support for employees and firms, helped also by our indeed successful SURE instrument. Various short-time work schemes kept workers attached to their jobs. In short, policymakers learned from past mistakes and responded very decisively. National measures with a direct budgetary impact amounted to almost 4% of GDP last year, with liquidity support and guarantees amounting to around 19%. To some extent, though, the standard labor market indicators hide the impact of the pandemic. They don't say all the truth. Last year saw an increase in underemployment, which is not covered by the unemployment rate. For example, house workers collapsed in the first half of the year. In addition, forward-looking indicators of the labor market signal the persistent negative impact of the pandemic. Last month, the Commission's Employment Expectation Index remained markedly lower than before the pandemic. With the recent resurgence of the virus and less favorable near-term outlook, job retention schemes remain the first line of defense for workers. When, as assumed in this forecast, restrictions are progressively eased later in the year, many people in services and retail are expected to return to their jobs. However, it cannot be taken for granted that all employment relationships will remain intact after the retention schemes are lifted. So, policymakers at all levels must remain very agile. Underlying price pressures, we are now talking of inflation, underlying price pressures are expected to remain subdued this year and next. However, based on the oil price assumptions and owing to the end of the temporary reduction in the German VAT rate, euro area headline inflation is expected to move slightly higher in the coming quarters. In 2022, once the expected recovery takes hold, upward pressures on inflation should only increase marginally. Overall, inflation in the euro area expected to increase from 0.3 last year to 1.4 in 21 and 1.3 in 22. In the EU, it is forecast at 1.5 in both years. Following the contraction in almost all member states, except Ireland, GDP is expected to expand in all member states in 21 and 22. And this is, of course, the famous light at the end of the famous tunnel. And increasing numbers are vaccinated and containment measures are gradually relaxed, economic activity is expected to start picking up. This means, to speak in terms of the growth map, that blue waves are set to lift all boats in the EU, providing we avoid any premature withdrawal of supportive policies. However, growth is for all, but however, significant country divergences are expected to persist. Such differences are, for example, related to pandemic developments, to the timing, duration, and stringency of containment measures, and to the economic structures of different member states. These cross-country differences result in a wide dispersion of real GDP paths since the beginning of the crisis. Both the downturns last year and the rebound this year and next are expected to differ widely. The EU is expected to reach its pre-pandemic level of the fourth quarter of 2019 already in the second quarter of 2022. However, 1 in 4 member states with quarterly forecasts are set to need longer. Moreover, as the slide shows, none of the member states is expected to return in 2022 to the growth path projected before the crisis. In 2022, annual GDP in the EU and the euro area will remain about 4% below what pre-pandemic forecast had projected at the time. Risks to the forecast, as always. Uncertainty remains high, and the risks to the forecast remain elevated. As compared to the previous one, the autumn forecast, risks have become more balanced. Several significant downside risks persist. New COVID variants could emerge and spread more quickly than assumed both in Europe but also globally. This could delay the easing of restriction and interrupt the economic rebound for longer than currently expected. Moreover, the pandemic could leave deeper economic and social scars than we think. The number of bankruptcies, that as you know was very low until now, could be higher with a more severe impact on potential output than envisaged in the most forecasts. Structural shifts could also raise the number of unemployed more than currently expected and further worsen inequality, including gender inequality. Finally, large cross-country divergences could become entrenched, disrupting the functioning of the internal market, could cause efficiency losses and ultimately becoming self-reinforcing. But there are also, and stronger than before, upside risks. The vaccination rollout could move more quickly than expected or effectively hamper virus transmission, which is something we do not yet know. This could lead to a faster improvement in the pandemic situation and allow governments to remove restrictions earlier than currently assumed. Pent-up demand could prove stronger, coupled with innovative investments. The strength of the rebound could surprise on the upside if historically high household savings, low financing costs, and supportive policies push demand more than expected. In short, one could say, compared to the autumn, we now face fewer unknown risks and more known risks. Many of these known risks are also policy dependent. It is up to us to ensure that sufficient support measures are in place for long enough and that fiscal policy continues to work hand in hand with monetary policy to sustain the recovery. Finally, I would like to underline that the impact of Next Generation EU and RRF has only been very, very partially factored in this forecast. This is because, in line with the customary no policy change assumption, our forecast only incorporates those measures that have either been adopted or credibly announced and specified in sufficient detail, notably in national budgets. And overall, this is not yet the case for recovery and resilience national plans. Following this approach, in fact, the economic projections of only a few member states take account of some of the measures expected to be financed under the RRF for 2021. What this means is that the economic recovery in 21 and 22 should turn out stronger than projected in this forecast as the national recovery and resilience plans are implemented. You may recall that our autumn forecast included a simulation of the substantial growth effect that could be expected. There could be a boost of up to 2% of GDP in the years of active operation of the RRF. More precisely, member states with below average GDP per capita levels are estimated to experience, obviously, the largest boost to output. Considering a 6-year stimulus, the level of GDP in 26 would be between 3 and 3.5 higher compared to a no RRF baseline. member states with above average GDP per capita levels would be likely to experience smaller but still sizable GDP effects. To put it in another way, this is, as we know, an historical opportunity. We can face the pandemic and we can rebuild better our economies. Of course, this depends also on efficient absorption and smart use of the European funds to support productive investment. We will come back to this and several of other issues in our spring forecast, which I will present in early May. Thank you very much.
Thank you very much, Commissioner.